When to do Roth conversions, part one. All right, so I've been working on this for the most of the day here, and I'm going to share it with you. It's a blog post I put. I'll read to you that I also sent my email subscribers. So again, if you want to become a subscriber, let me show you how to do that. Just go right here on hold on just a second. There we go. You go right here. You go to connect. So it's heritagewealthplanning.com and then hit connect, and that will take you to the screen where you say, hey, I want to select an option, sign up for newsletter, interested in financial planning, get access to software or other. So whatever you want to do, there you go. So that's how you get to subscribe to my newsletter. All right, so let's go back to the home page here, and you'll see this is Peaks Island, Maine. Your old buddy Josh used to sit on that wharf right there, waiting for the boat. This actually they changed the wharf. It used to be I can't remember. The car ferry used to be over here. They changed around, but anyway, we used to sit on this wharf right here. The wind would be flying. It looks like that kid's swimming right there. Yeah, look at that. Yep, there's a kid. He just jumped off there and climbed back up. That's what we used to do. But anyway, we used to sit on this wharf and just waiting for the boat to come pull us to the school in Portland. Oh, the wind would just be killing you, man. All right, so let's go down to my latest post. This is part one of many part series, which I'll end up doing in the book here. When to do Roth conversions. I get this question a lot. Roth conversions can make a big difference in your retirement planning. The rule of thumb is to convert when your tax brackets will be higher in the future. For instance, married people will have a higher tax bracket. Why? Because one of the people is going to die. And when that person dies, a single taxpayer has a higher tax bracket than a married filing jointly. Low-income people with decent retirement accounts will have a higher tax bracket. Between jobs, you'll probably have a higher tax bracket because right now you're probably not making it much money, if any. In the future, you probably will. And retirement before RMDs kick in, you probably have a higher tax bracket. So, in part one of this series, after retirement but before RMDs. Let's start with a simple example of a married couple just retired when the husband turns 60 and the wife 56 with an IRA balance of $500,000. They need $4,000 a month to cover all their needs. The husband's PIA is $2,900 and the wife's is $1,000. They don't plan on taking Social Security, though, until the husband hits his full retirement age at 67, and the wife will claim then too, but her spousal benefit will be reduced because she won't be at full retirement age. She'll be 63 years old. For the next 7 years, they'll need to withdraw from their IRAs to net $48K a year to live on. Well, we do adjust that with inflation too. Once Social Security kicks in, they'll need to withdraw less from their IRA simply because they were living solely off their IRA. Now they're living on Social Security with a little bit from the IRA. So the question is, should they do Roth conversions during this time? Let's see how it plays out. So here we're going to give an example, no Roth conversions. Let's start with a typical retirement scenario where they do no Roth conversions and instead just take distributions to cover their expenses and later the RMDs when they reach 70 years old. And you can see graph one. So husband retired there at 60 and they're just pulling money from their IRAs to live on. They're getting a 5% tax bracket. They hit about 7% there. And then from basically 66 to 73, there's no taxes. Or I guess that'd be 67. When Social Security kicks, 67, excuse me, it's 73. Because when Social Security kicks in, they don't have to take as much out of their IRA. And because the Social Security is, the IRA, the withdrawals are essentially the equivalent of their standard deduction, they have no taxes. So in this case, even though they have Social Security income plus a little bit of distributions from their IRA, their standard deduction wipes away any taxes that are due. All right, but now what happens, 72, 75, 80, you can see 5.2% is a tax bracket there. Then you can see right here is about 10.5, 11% right there at 90 when the husband dies, and then it jumps quite a bit to 12.5% due to the widow's tax trap. What you see here is at the beginning of retirement, before Social Security kicks in, they have around a 5% effective tax rate because they're taking distributions solely from their IRA to make ends meet. However, once Social Security kicks in, the distributions from IRA drops and they actually have no taxes for about 4 years or so. But when the RMDs kick in, those RMDs will force them to paying taxes again. In fact, the taxes will increase each year as the RMDs become larger and larger. At 90, when the husband dies, again, the widow's tax trap kicks in. And so here's the issue. The wife's taxes will increase by 34%, even though her income will drop by 25%. So here's her income. It went from 102 to 77, and yet here's her taxes went from 14 to 8 to 19. So a 34% increase in taxes to offset by a 25% decrease in income. That's the widow's tax trap. So what if they say, yeah, they don't like that scenario, so we're going to do Roth conversions as full retirement age for the husband at 67. And here we'll show you here, they're going to, again, they're taking money up from their IRA to live on. At 67, they're still pulling money from their IRA, and they're doing Roth conversions, but they also have Social Security kicking in. So here, living solely off IRAs. At 67, they're living off a little bit off IRAs, mostly Social Security, but they're still doing some. And I'm doing $35,000 a year Roth conversions here, and they're doing Roth conversions at $35,000 a year. And you can see they get an 8% effective tax rate here. It slowly goes down to about 7% there. And then when the husband is 78 years old, there's no taxes. So they're paying some tax up here for no taxes later on. And then, of course, when he dies, there is no taxes. And here's I show you the taxes here. So the income still drops by 25% from 102 to 77,000, but the taxes are zero. So when the widow's tax trap, there is no widow's tax trap because the income, while it does reduce, there is no taxes at all. And so if we go back here, income drops from 102 to 77, taxes go from 14 to 19. Here, income drops from 102 to 77, there is no taxes. All right, so notice unlike in graph 2, when the wife's income dropped by 25%, the taxes went up by 34%. In this case, because the Roth conversion, the widow owes no taxes. In fact, even while the husband's alive here, there's still no taxes due at all. And I did all this on Right Capital software, by the way. With the Roth conversions, they paid a total of $87,000 in federal taxes. And I did not use any state tax. I just put them in Tennessee because I don't know. The state tax is different. And the Right Capital is a little bit disappointing when it comes to Georgia because they had these guys paying 4% state tax and they're not paying 4%. Once you're over 65 years old, with this kind of income, they're not paying anything. Without the Roth conversions, though, they will pay $100,000 more in taxes for a total tax of $187,000. With the Roth conversions, they'll pay $87,000 in tax, and that's just the nature of the beast. But again, without the Roth conversions, they're not paying that much tax on the front end. Well, we go here. They're paying effective 5%, but it's on the back where they really start getting crunched. And then, of course, when the wife is a survivor, she gets hammered for sure. But she's paying $22,000 at that point. All right. Let's see here. Now let's take a look at the total net worth. Remember, one of the drawbacks during the Roth conversions is that you have to pay taxes when you convert the money. Those taxes are money that inherently can't be used to grow the portfolio. So we're thinking, well, if we're doing Roth conversions and that taxes aren't being used to grow the portfolio, what is the net worth? Well, I appreciate we have $100,000 less in taxes when we do the Roth conversions, but won't that hurt our net worth? The answer is no. Because what you'll see here is their net worth is right here, $1.7 million, of which $529,000 that is in qualified assets. In this case, a deferred IRA. $1.1 million is in non-qualified assets because their Social Security, they didn't have to take that much of their RMDs in which to live on. So whatever they had to take out of RMD above and beyond what they need to live just went into a taxable account where there's just building capital gains, long-term capital gains, dividends and interest and whatnot. So they're leaving their heirs of 1.172 tax-free, but they had to pay a lot of taxes in the interim to build that. And then they're leaving their heirs with $529,000 of tax-deferred accounts, which the heirs will pay tax on that because it's qualified to IRA at ordinary income. So what graph 5 shows us is that at the death of the surviving spouse, they're leaving a liquid net worth of $1.7 million. Not too shabby, but unfortunately, a good amount of that, $529,000 to be exact, is left in an IRA, which will be taxed to the heirs as ordinary income. Now, because their mandatory distributions were higher than the amount they needed to live on, they did leave $1.17 million in non-IRA account, which will transfer under current law to the heirs tax-free. However, they did have to pay tax on that money via capital gains, dividends, and interest while they're alive, which increased their taxes. If we look at graph 6 below, though, we can see what their net worth looks like when they were doing Roth conversions at 67. Net worth is about $70,000 less. As you can see, $1.6 million here to $1.7 million, $1.63 million here to $1.7 million there. So $70,000 less of taxes, but a less of net worth. But watch this. They are leaving $1.63 million all in a Roth, So that is the kids are inheriting that all in a Roth. And if we get, $529,000 that the kids inherit. We'll just take 25% off that for state and federal taxes, minus 25%. That's only going to net them $390. So at the end of the day, this is significantly higher. 1.63 tax-free is much higher than 1.702 taxable, if that makes sense. Now let's do Roth conversions at 60. And we'll assume this couple loves the idea of not paying taxes in the future and want to begin Roth conversions ASAP. How does this shake out? Well, in this case, they only pay $55,000 in total taxes over the first few years of retirement and then pay none ever again. Even after the husband turns 67, they pay no more, which is $130,000 less in total taxes than not doing any Roth conversions, and $30,000 less in taxes than waiting until 67 to do Roth conversions. In fact, here's a graph. You can see they're paying about that's about 8.5% effective tax rate until they're 67. Then they're going on Social Security. They're not paying anything. All the taxes are gone. Kaboom! Roth conversions at 60 lead to no tax after 67. Now, wonder why, what you might wonder what their net worth looks like, because they did have to pay those significant taxes on the front. I hate to say significant, but $55,000 of taxes on the front end. So let's see. They actually leave a bigger legacy than they did if they waited till 67 to take the Roth. We got $1.639 million versus before $1.63 million. So that's an extra $9,000 tax-free that they're leaving to the heirs. So not only do they pay less in taxes, significantly less, they pay $30,000 less in taxes by doing the Roth conversions at 60. They pay $150,000 less in taxes by doing the Roth compared to not doing the Roth conversions, and they leave a substantial net worth, much more so than not doing Roth conversions, and still $9,000 more than if they waited till 67. So it seems to me that's a slam dunk. So one thing we haven't discussed, which we'll do in part 2, is what happens if they have a secondary source of income, say a pension. So we'll throw a $30,000 a year pension in the mix and see how that looks. And we'll probably put that pension with a wife. So there you go. As always, if you want to come here and get my blogs, just subscribe to the blog post here thing. Don't forget to subscribe to the website without question and put comments down below. All right, thanks, guys.